Banks and NBFC stocks are facing renewed pressure. This is because after the Reserve Bank changed the rules to make personal loans, unsecured loans, costlier, the governor gave a hard-hitting speech earlier this week where he, for the first time, appeared to raise some doubts over algo-based lending. Secondly, he said because of high and growing exposure of NBFCs to banks, there can be a contagion fear. That is, banks will be impacted if NBFCs become weaker in some fashion or face defaults. Now, the NBFC body, the FIDC, has written to Reserve Bank requesting that the increased risk weight on bank loans be removed. Now, let's assess the impact as of now, after all that we know, impact on NBFCs, fintechs, and actually the overall credit growth in the system. I have with me Mr. Umesh Revankar, Executive Vice Chairman at Shriram Finance. He also heads the FIDC. Nitin Chugh, Deputy Managing Director at SBI, heads all those algo-based modeling in SBI. Suresh Ganapathy, Banking Analyst at Macquarie Capital Securities. And Jinay Gala, the Associate Director of Financial Institutions at India Ratings and Research. Gentlemen, thank you very much indeed for your time. Mr. Revankar, I know you are in a hurry, so I'm going to start with you. Well, you know, RBI has only made it costlier to borrow from NBFCs. Why are you writing this only from banks? You can borrow from the capital market. Then why this letter to the Reserve Bank?
See, as an industry, there are multiple choices or sources all the time. That's not a constraint. But Indian capital market is still shallow, so it is not deeply, penetrated, and it is not really large enough for the industry as a whole to go to capital market. That's one thing. And larger players can always go into capital market and raise resources. And what we feel is that the supply to NBFC as MSME segment can be restricted because even though the focus is on the consumption loan, but the segment which we are focused, that is a business community, MSME lending, which is now growing post-COVID, it should not be stalled, or the cost to them should not go up.
Okay. Suresh, have you done any calculation? What may be the total exposure of banks to NBFCs? Say, even if you have of one particular bank or one particular NBFC.
No, that is available anyways, Lata, in the public domain. Or as a percentage of the last 12 months incremental credit, almost 15% of the incremental credit has gone to the NBFC space. And that's a significant amount, right? You're talking about just one sector alone contributing 15%.
Okay, 15% of the loans given by banks is to NBFCs.
Of the total credit disbursed or other
incremental
over
credit.
The last 12 months, incremental credit, 15% has gone to the NBFC space.
Okay.
Now, of course, this includes priority sector, non-priority sector, everything put together, but that's a significant proportion. And note that, Lata, this has been growing at anywhere between 25 to 30% for the last 2 years, which is why the Reserve Bank of India is worried about that. There is too much exposure. And just to, support Mr. Revankar's comment, as a proportion of the total NBFC's books, banks as investors, banks as suppliers of credit, both through the loan route and through the subscription of commercial papers and bonds, is closer to 40 to 50%. And that's why Mr. Revankar has a point, is that you go to bond market, there also banks are the ones who are subscribing because the total exposure is 40 to 50%.
Okay, but let me come to India Ratings. Jinay, you have a more specific number on how much is the exposure of banks to NBFCs or how much is the dependence of NBFCs to banks, and what is the rate of growth?
Sure. So if you look at the rate of growth, I think so this has more than doubled. I think so the RBI has been quite supportive to the banks post-pandemic and also during the pandemic. The exposure to the NBFCs has started rising during the pandemic, and now it has gone full float. And if you look at the growth rates has been around 25 to 30%. Now it has come down to 25%. But around 14 trillion of exposure stands to NBFCs, overall NBFCs, which would include HFCs also. So stating that, and so as Suresh pointed out, the exposure still remains at around 14 to 15%. And as the Revankar sir also pointed out, replacing this kind of a funding through capital markets remains a quite dicey thing, because NBFCs are also growing in size and scale, and their incremental requirements would increase.
Okay.
So if the bank starts to curtail their exposures to the NBFCs, there could be a pricing markup on the cost of funds for NBFCs, and also their ability to borrow from the capital markets is also limited.
Got that, Jinay. Let me get to Mr. Revankar therefore. Mr. Revankar, net, what may be the impact of this higher capital cost? Will it be a margin pressure, or will amount of loans that you give itself come down?
I think, margin pressure is ultimately will shift it to the what you call yields. And as yield goes up, then the cost to MSME goes up. And automatically, the volumes will slow down. So that is what's going to happen.
Okay. So we are very clear that NBFCs will definitely face a volume slowdown, and we have to see margins. There is, of course, the capital impact. I'll come to Jinay on that in a bit. They've done some capital calculations. But let me raise the other issue that the Reserve Bank governor went hammer and tongs saying this solely based on algo-based lending or model-based lending is a bit of a worry, and the models should be constantly recalibrated. Nitin, if you can explain to us, how much of the lending is done through algo, all these new fancy words like AI and ML, and how much is by the good old CIBIL score?
I think the algo-based lending has first found its way into unsecured lending to begin with. And those models have been around for a long time. And I think they've been tried, tested, they've gone through multiple cycles. And I'm talking about banks, I'm not talking about NBFCs and fintechs. And the large ticket loans, whether they are secured or they are of the nature of any kind of collateral-based lending, they go through the conventional way of underwriting. Okay, there are feeds that come from multiple parameters. There is obviously a scorecard that's prepared in terms of making sure that we get the right kind of risk scoring. But that is only one input parameter in terms of the overall underwriting outcome. But I think the issue really is about whether or not these models are robust enough. Do they keep changing with the changing macro environment or the other parameters that come in? And speaking for SBI, I think we have a fairly robust governance process on these models. And there is this whole phenomenon of something called data decay or concept drift, where the whole idea behind the model actually starts to fade away or drift away from the original hypothesis, and the recalibration becomes very important. So most AI-led models, even though they are pretty recent, they actually go through a whole lot of recalibration again and again. And if at all the data scientist team will find any kind of a deviation from the expected norms, we can even go ahead and halt the model. So I think we are reasonably cognizant of the fact that it cannot be an exuberant lending only based on algos, and it does require a lot of oversight.
One minute. Nitin, I take a point from a bank like SBI, but if you can give us an idea, this is how banks lend, right? You all have a scorecard-based lending, and on it you all also apply algos. Is that how it happens?
So I'm saying that the consumer loans, largely personal loans, okay, they, over a period of time, especially for the salaried customers, they have gone through some kind of an algo-based lending, because these algos have got tested and they've got recalibrated time and again. And it is showing up in the portfolio quality of all the banks. I don't think any bank has a problem.
No, but if you only dependent on them, or is it because as banks, you all also have the deposit history, you have a transaction history, something which a fintech may not have?
Exactly, and I'm not saying that that is the only way that the lending happens, because there is obviously a check, like in case of our personal loans, there is a requirement for the customer to actually do something, on a physical basis at some point in time if the model requires us to do that. So I think it's a mix and match of the risk profile as well as what the algorithm is telling you. But the ones which are tried and tested, which have a good track record, we have a good transaction history, and there is an easy way of also communicating to the customer and making sure that they are able to consume those loans without too much of a difficulty, where we don't envisage too much of a risk. They go through this kind of a straight-through process.
Okay.
But I'm again saying that these are recalibrated again and again.
No, it's recalibrated in your case, but I mean, we'll have to, unfortunately, I don't have any fintech with me. I begged so many of them, but everyone appears to be busy. What about your view, Mr. Revankar? These fears raised by RBI about algo-based lending. Now, NBFCs do a lot of co-lending through the fintechs. Fintechs originate the loans for you. What are your views on these doubts raised by RBI?
Basically, there are multiple variables which is taken into account for lending. The credit score, which has been used for last maybe 10 to 15 years extensively, that is simple arithmetic or statistical based. Algo has a lot of other variables that get captured. Some of the fintech even told me that there are 160 variables they track to see the possibility of delinquency and what is the cash flows, how to lend. So it is only helping you to take a better decision making. So whether it is a credit score or algo, but they are not 100% sure to assess. Like imagine if you had lent just 2 months before COVID, and if the COVID had come. Now, what helped everyone to get over the COVID was the moratorium. It was not anything else. The moratorium by the regulator helped everyone to go through the cycle and come back without much of the challenge. So it's only I really don't see whether it's algo or the credit score is superior or whether it's increase or decrease or whether ultimately it's the interface of the lender to the borrower is very important.
Yeah.
And if you don't have that interface while lending or post lending, then you will have some challenges. So the mechanism of the engagement with the borrower is very, very important. So we can't be just
I get that. You have to continue hand-holding, do your own due diligence, not just go with what the fintech is telling you. Suresh, I want to get you in on that. This is hearsay. Let me be very frank. I spoke to a lot of bankers and NBFCs who didn't want to come on air, and they were raising some doubts about, this 160 parameters that Mr. Revankar is talking about. Apparently, some of them say, those who set their alarm at 6 a.m. are normally people who are disciplined and they don't default on their loan. Even such parameters are included. So, is the governor right in raising doubts that totally algo-based lending is not good enough?
No, the data is there to speak for itself, Lata, right? So if you look at many fintechs today do have credit costs which is running in double digits. These are really large numbers. And also note that banks and NBFCs, many of them have also safeguarded or have ring-fenced their lending. So though the FLDG rule is 5% synthetic and straight FLDG, unfortunately, all kind of convoluted structures exist whereby they are getting money from the fintechs in form of some service fees and collection fees. So effectively, banks and NBFCs have guarded themselves, but the eventual hit is being taken by the fintechs. Look at the RBI's data itself. For less than 50,000 rupee loan, as per CIBIL, the actual NPL levels, 90-day NPL levels today are running at 6%, almost 6 times of overall personal loans. And if you were to really look at on a 30-day basis, these numbers are all in double digits, which clearly means the algo-based trading is not necessarily working at all. I mean, the basic check is salary and income level of the guy, and I'm not sure whether that is being done.
Okay, I'll get back to Nitin on this, but one quick word from you, Jinay. Is it true? You all may be rating fintechs as well. More bad loans in their unsecured personal loans, fintechs?
Yeah, so on the bad loan front, it depends upon the ticket size at what you are lending at. Different ticket size throws a different kind of delinquencies. But the fintech as a space has able to broaden the market. If you look at, there are a lot of transactional data which are available right now. Also, a lot of the phone-based apps which are available, the fintechs are able to scan through the phones and get into what kind of inquiries a person is making in. So a lot of data accumulation is happening, and based on the permutation and combinations, they tend to arrive at a eligibility of a borrower and his ability to repay. Now, a lot of this gets risk priced also well. If you look at the pricings of those customers are quite high, and where the risk pricing is also there. But the key challenge is that customer profile tends to remain vulnerable to the economic down cycles. And whenever there's an economic down cycle, there could be a spike in the credit cost or spike in the delinquencies.
No, that is another issue altogether. When there is an economic down cycle, there will be. My only point is whether there are more doubts to be raised from fintech-originated loans. I want a little more clarity on that from especially Nitin, and the overall impact on NBFCs, fintechs and credit growth. Those questions in a minute after this break. Welcome back. We have been discussing the fresh fears raised by the Reserve Bank governor in his speech earlier this week. One, there were some doubts about algo-based lending. And two, this contagion effect. Because banks are overexposed to NBFCs, whether any higher default in NBFCs will fall on the banks. I've been speaking with Mr. Umesh Revankar of Shriram Finance, who also heads the FIDC, the finance industry's body, NBFC's body, Suresh Ganapathy of Macquarie Capital, Jinay of India Ratings, and Nitin Chugh, the Deputy Managing Director at State Bank. Nitin, to directly answer this, ask you this fintech issue, are loans originating from fintech more likely to go bad? This is what one of the NBFCs, Chola Finance, said in the conference call, that fintech-originated loans showed slightly higher defaults.
I think what Suresh spoke about, and he did publish a report a few months back exactly on this, quoting this report, it is already showing. So I don't think there's any denying the fact that some unnecessary risks have been taken, by the fintech lenders. And this is where the difference between algo-based lending, which uses data, which is essentially surrogate data and not the core data, versus a bank using the core transactional data and on top of it, any other form of useful data, the models become very different. When lending is done on the basis of a 6 o'clock alarm wake-up call, things are bound to go wrong. And I think that's already showing up in the data that Sibyl published and what Suresh also published. In fact, today also Suresh has published a report on exactly this. But I think it is already there to be seen.
Okay. So, Mr. Revankar, do you think NBFCs will reduce their co-lending partnerships with fintechs?
NBFC and fintech, I think the larger NBFCs have their own business model and they have underwriting practices. We are not dependent on fintech for building businesses or scaling businesses. I think that kind of a dependence will never be there.
No, I don't think there's dependence, but whether you will just want them less. Suresh, what is the hierarchy of impact? Who gets worst and who's least? And more importantly, are we going to see slower growth because of slower consumption?
Yeah. So let me take this last question first. Lata, it's very clear, right? What is RBI looking at? It's looking at the growth numbers for lending to NBFCs and the unsecured loans. And the governor himself has explicitly gone ahead and said that at this point in time, there is nothing to worry. So what's happening is they're looking at growth numbers and saying that possibly if you look at the previous cycles, strong growth pace has been, subsequently followed by a high NPL phase, right? So the only way the problem gets solved or the RBI gets satisfied is slower loan growth across the board. So it doesn't matter. Everybody is going to be a loser in this game. Banks, NBFCs, fintechs, everybody's growth has to slow down over the course of next 6 to 12 months. Extent of slowdown will depend upon each NBFC, each bank, their exposure to the NBFCs and fintech space, right? That's one thing. Secondly, the impact-wise, the most impacted is going to be fintechs. I'm looking at a combination of both the exposure as well as the cost of funds angle. Then it moves to the NBFCs and PSU banks because PSU banks' capital levels are pretty low. And then finally, the least impacted on a relative basis could be the large private sector banks because they have enough capital and they can manage the exposure-related issues relatively better.
Okay. Similar question to you, Jinay. What is India Ratings' view of overall, how much of consumer lending is dependent on loans and therefore how much can be affected? And again, who are the casualties? in order of severity?
Yeah. So if I start with the last question first, I think so in terms of casualty, the fintechs is the major one. I think so in that we have assessed that the tier one exposure could be impacted to around 700 basis point, where they need to raise capital incrementally to continue the same growth momentum, or that would delay their gestation of break even. Second level of impact would be on the NBFCs. A lot of these NBFCs would have the partnership lending with the fintechs, where we see the capital exposure could be somewhere around 25 to 300 basis points, depending upon the unsecured personal loan book in the different NBFCs. And also, the impact would be on the banks, and that would be largely around 50 basis point on the overall banking system. It could vary from lender to lender specific. And if you look at the overall scheme of things, this would definitely curtail the growth momentum of unsecured lending. This growth for the NBFCs as a percentage of sanction was around 25%. And that was rising on a quarter-on-quarter basis. So that has largely led the governor to take cognizance of the fact that this could be a proactive measure taken by the regulator, which could curtail the growth on the unsecured side. And also, this would also bring down the growth for the overall system also. So if you look at the system level growth was around 18%, but there were few NBFCs who were growing at 25 to 30% at the overall growth level, and that also at a very high balance sheet size. And this is the key area, I think so, which the governor was not comfortable with and would also have taken a cognizance of that.
Okay. Thank you very much, gentlemen, for giving me some very stark numbers. Mr. Revankar, Suresh, Nitin and Jinay, thank you very much for joining me. The key takeaway, overall credit growth in the system, which was running at about 15%, could go down to about 13-14% is the guess. And the order of impact, severest on fintechs and then on NBFCs, which are doing personal loans and not so much on housing finance and vehicle finance loans. Banks less affected because most of them have the capital buffer. Wrap up on Indianomics. Thanks so much for watching. Chartbusters up next.